Custom sharing server.
Yep.
Cool.
Go with this one. And start going. All right.
Cool.
So here we are, Corey.
Happy Wednesday.
Happy Wednesday. Another raw take for CEOs. Today's March 10th. What's going on?
Crazy.
What's going on in the world today?
Seems like everything's, we're reading the headlines together. It seems like everything's kind of on the up and up. Kind of marks 1 year, roughly next week from, I think this week we shut down last year. We were about a week ahead. It's kind of just reflecting back on that time. A lot happened in 2020.
A lot of books will be read about it. That's for sure. Yeah, no, it was a year ago. School shut down, businesses shut down. A lot of challenging conversations.
Yeah.
A lot of management teams behind the Zoom calls or behind doors. We were here in the office planning out our expectations for the upcoming. Well, at that point, we were talking like 3 months, right?
Yeah.
We were talking about getting together in August with the team for the summer cookout, which that didn't happen, but we're all still at the table.
Also healthy, so important. And it's kind of ironic bring that up because when looking back at the headlines that we're just reviewing this morning, it looked like a lot of them were all kind of on the up and up. Right, a lot of businesses kind of turning around, talking about invested capital, talking about bringing jobs back. And some of the jobs reports lately have been kind of more positive than expected. So, kind of hopefully, knock on wood, turning a bit of a chapter.
Yeah, I think seeing some things come back. Obviously, some businesses, some industries are still very much pushed down.
Yep.
But yeah, the headlines have all been about call it the risks and the opportunities, right? The liquidity, cash. Some companies' sales are up dramatically, some they're down dramatically, but in the end, it all comes back to cash.
Yeah.
I was just on the phone with a customer yesterday, and what was the quote? It goes back to cash is king, everything else is queen, and it's so true.
Yeah.
So true. And that's what. So last week, Dan and I, and so Corey's stepping in for Dan this week. But last week we kicked off March Cash Madness, and anybody that's interested, I still don't know anything about college basketball more than I did last week, but I know enough to try and play on the words, and we're putting March as March Cash Madness here on the Raw Take for CEOs.
Cool, love it.
So some of the headlines we were looking at, thinking about liquidity, whether that's Target investing in their stores because people are shopping in different ways. They're seeing an uptick in their retail, right? But they have less of a need for in-store operations. They have more of a need for that curbside pickup that we're all doing so much more of. Like they're actually investing more of their capital, of their cash in the stores so that they can be more agile, more address the market. GE Capital shutting down, like a big move. That's a big that GE Capital.
Yeah, no, it really, what I feel like I've found and read lately is it really depends on the industry, right? Because what I've seen with a couple of our customers that are on that retail side, right? It didn't just take capital to get through 2020 in terms of paying your rent, paying your employees and stuff, right? But for some retail businesses or some that were more in person, they really had a shift in inventory, right? The same things that would sell in person maybe didn't sell online, right? And now the conversation becomes, with hopefully a light at the end of the tunnel, do they have to now reshift that inventory to accommodate for that? So,
right.
So it really depends on the industry, but I think what's kind of our goal is to talk about today is kind of that cash causal and how cash is impacting these businesses, regardless of whether you're a startup, operating business, or what industry you're in, right? Kind of a global approach.
Yeah. So today's about visualization, right? So and the key one that we go to, if we had to pick one, is that cash causal, right?
Yeah.
And we do want to differentiate between kind of the venture-backed companies and startups, whatever outside capital they might be getting.
Sure.
and operating companies. Those that are really more funded by the majority of the small business world. You're funded by free cash flow. You might be looking at us or listening to us and say, "Well, I had no free cash flow last year." But yes, you didn't. But that meant that you had to find other ways to boost your liquidity, whether that's from a PPP loan, an EIDL loan, other SBA loan, your own capital to keep the business afloat. Those are all the daily lives of the small business owner, particularly in 2020. So we do want to talk about visualizations. We do want to talk about cash causal and how we see our customers using that both for a tool themselves between venture-backed and operating companies and with their stakeholders.
Yeah, and this is something that I think relates to a couple topics we've talked about in the past, and we'll kind of come full circle on these. But it's not only a exercise that we do on because of the past 12 months. Like this is something that we've worked with businesses on, and we look at ourselves pre-COVID, pre any of this hecticness. So it's a good exercise to go through, whether it's on some sort of recurring basis, but especially now we're seeing it really necessary.
Yeah, and we do have visuals. So for those that are joining us via the video stream as well, you'll have that added advantage. Those that are listening to this in their car, don't try and stop it and look, but we'll walk you through it. So when we're talking about venture backs, and operating companies, we started to define those. But let's kind of start with the venture backed world. That's your traditional startup. You've got a great idea. You've got opportunity to make $1 billion company over the next 5 years, and you're going to sell it to a strategic investor. You need a lot of capital, right? You're not building this bootstrapping it. You're not waiting to grow it over the course of 20 years. You want to grow it over the course of 3, right? And so you need a lot of fuel in the tank, and you're going to be putting pedal to the metal, and therefore you're going to be burning cash, right? It's not going to be the most efficient money spent, whether that's sales, whether that's product development. You're going to be have as fast as acceleration as you can, so that you can get a lot of iterations in, figure out what works, what doesn't work, what's going to be a product market fit, what's not going to be. So you're burning through cash, right? Even as you get through the Series A, Series B, you're still burning through cash. And how is that? It's because you're still accelerating, right? It takes capital to grow. Whether you're a startup or whether you're an operating business, it's just where does that capital come from, right?
Yeah.
And that's where this kind of cash causal, cash waterfall really kind of comes into play to help people understand, where did I start and where did I end, and what all happened in the middle, right? Because I may, it's easier, so to speak, for the startups to say what happened in the middle. I raised $2.5 million, and that's what happened in the middle, because they do know that their cash is going to go down across the year, and that's not a surprise, right? So when we use the cash causal for startups, Korey, it's more like what functions did that cash go to, right? Because the customers of this are the managers, right? But it's also probably more importantly, it's the investors, the board, and the future investors. Not only where did I spend the capital, but where am I going? I'm going to raise another $10 million, and where are you going to spend that, right? I want to make sure that I as a new investor in your business know that you're going to be spending it in ways that are going to drive, that I believe with you, that are going to drive value in the future.
Right?
You'll
hear us talk about we've thrown out cash causal, cash waterfall. And another simplified term is kind of the sources and uses of cash, right? Where are you sourcing that cash from? Right, for a startup, that's probably investors right now. You can almost go in with the mindset that you are going to lose money for the first
X number of years.
Amazon didn't make money till 2 years ago, something like that, 3 years ago. So you almost can't look at the P&L even on a cash basis, because it's just not a true picture of kind of the cash flows of the business. On the startup side, it is a little bit more about, you'll see a lot of losses, probably a big drop in that cash causal, and then a big spike at the end, right? Maybe I'll kind of share my screen for those that are watching visually.
And for those that aren't, like what we're looking at here, you can think of it as a bar graph. It's a snapshot in time, let's say, of 2020. Of where did I start with my cash and where did I end? Your start is on your left, your ending cash is on your right, and you got bars that go up, and got bars that go down across the year, and it's a simple visual, but you would be surprised at the reaction that we often get, whether it's from investors, whether it's from bankers. Like, it's just a different way of looking at your numbers, right? It's not a P&L, it's not a balance sheet. It's bringing those things together. I remember one of the first times I looked at one of the simple dashboards that connects to QBO for customers. It was it's a simple visual, but it makes a world of difference, right? Because people are cash is king, everything else is queen, right?
Yeah. And it also just helps. So what I find personally it helps with the most for me is not only like the big overview of what's going on, where's money coming in, where's money going out the door, but just helps to really understand the magnitude of the different proportions, right? It's one thing to, I think, personally look at the numbers and read them off of a P&L, for example. And it's a whole other thing to look at a graph and see, the sliver of cash inflows from true customer collections versus the amount of cash outflows from R&D expenses, product development, etc.
Yeah, so what we're looking at here is, our starting cash is the black bar on the left. They entered the year with not too much cash reserves in the bank. And this is just fictional data, but not too unrealistic for any company that's trying to raise money. Second half, especially Q4, often gets pushed till the beginning of the year with holidays, etc. But anyways, entered the year with not much cash. Across the year, generated, let's say $100,000, $200,000 of revenue. Like, that's good. I'm glad you're collecting cash, but we've got like $1 million plus of expenses here. Most of these are OpEx. It's probably a service-based business.
Yeah.
We've got $600,000 in product development, another $400,000 in sales and marketing, and these are all like going negative numbers. Get us down to 1.5 million that we would have lost across the year. And if starting with cash reserves of 100,000, that's we're out of business, right? But we saved ourselves by raising $2.5 million, and so at the end of the year we got $1 million left in the bank.
Yeah, and I think to your point, Steve, kind of that this is a great historical representation, right? Now, how do you move this forward, right? Now, what would this look like if it's a year from now we're starting with about $1 million in the bank? Now it kind of becomes a conversation that you talked about. This is not only great for historical, what did happen, but appealing to future investors. How are we going to use your money?
Yeah, and if you take this on a kind of, this is a 1 year snapshot, right? Here's the 6 categories of expenses buckets that we're looking at, expense and cash inflows, cash in and out that we're looking at. Take this as a 1 year snapshot, replicate that 3 times, give you a 3 year look forward, right? And what you want to see there is, for any startup, right, is that your revenues begin to tick up, and your expenses probably stay either similar, or if you're really putting the pedal to the metal, those are continuing to expand as well, right? So you see that you are driving more cash collections from revenue sources, but you still need that influx of invested capital, right? This was a $2.5 million raise. The next raise will probably be in the $10 to $15 million range. To continue to put fuel in that tank to drive sales and marketing, product development. At some point, product development would be able to go into more of a maintenance mode, or you continue to innovate. But that is the world of startups, and it wouldn't be until 2, 3, 4 years out that you see that cash inflection point, or the cash break-even point, right? Where you will see that your cash collection in a year is at or greater than all of your expenses, right?
Yep.
And that is for startups, that is the kind of the holy grail of when are we going to get to cash break even?
Yeah.
And that's not the same as when am I going to return money to my investors, but it is that point where your cash collections at least equal in that period your expenses.
Yeah, I feel like this waterfall, especially on the startup side of things. At least for the first few capital raises, seed round, Series A, B, however far you're really going, you'll probably see a big drop off with a big spike in capital raised up until 1 year, and it will kind of flip, right? Because the only reason you're really raising that capital is because you're funding the losses of the business, right? And it's up until that point where that capital invested gets you to that break-even point, that inflection point where you can ramp up customer acquisition, and then this whole thing will kind of flip upside down. So it's an interesting visual to kind of keep an eye on and look back at historicals and plan for the future. And it's kind of transitioning over to the operating side of things.
Yeah, one last thing before we come over there, because I think it's what are the insights that you're giving, right?
Sure.
And starting to talk about the differences here versus the operating companies, because when we look at the operating company cash waterfall, it's going to look a lot more it's not going to look like a balance sheet, but you have balance sheet items in there, like changes in AR, changes in working capital, right? Those are the drivers. Those are our bars. Versus here, that's not meaningful for a startup, right? What's meaningful for a startup is where functionally am I spending those dollars? Because I am doing that to achieve a milestone. And that's the way startup funding works, right?
Sure.
Achieve a milestone and get more capital. Achieve a milestone and get more capital until you get to that place where you are generating net generating cash rather than net consuming cash. But for the operating businesses, it's less about where am I spending that, because I should be theoretically at a maybe 15, 20, 30% growth.
Mm-hmm.
I'm not at a 500% growth. So I should be able to see my metrics fairly similar, right? So my AR, all the things being equal, should stay the same from year to year. If I've got a big change in my receivables, that's going to consume cash, right? Mm-hmm. And those are the bars on the operating business cash waterfall. So the consumers of this is really your investors, your board, showing them kind of visually where you've spent all the money and what you've achieved.
Yes, the key there, what you've achieved with this.
Cool. And these two categories, I know they're kind of big brushstroke categories of venture-backed and operating companies. Obviously, there's nuances of industry, there's scale, there's size, there's tons of things going on here. But in terms of like what you actually are consuming on the cash on this visual side of things, it is a good kind of bucket to put things in.
Yeah, no, definitely helpful. So we brought up on the screen for those that are watching, we'll kind of include this slideshow on in the description of the podcast, so that anyone that wants to leverage this as a template or can just take a look at what we're talking about, you'll be able to see this. We have up the operating cash waterfall, sources and uses of cash, and so here's the point, Steve, just kind of reiterate. These categories is the first thing that you should look at, right? So they're very different, right? And so in this scenario, we have our beginning cash balance. We go through to our net operating profit, or in this case, loss. We have some other expenses.
So it's kind of like thinking about 2020, right? A lot of businesses had a loss. That doesn't mean they were it couldn't be at negative cash at the end of the year, right? So you have to have some mitigating issue there, right? So sure. I didn't have as much sales, still had all my expenses, therefore I had a bigger loss than usual for the year, right? Usually I make, let's say a small business, I usually make $100,000 to $200,000, kind of almost break even, right? Now I'm on the other side of that, on the other break even, and I'm eating into my cash reserves, I'm eating into my maybe the owner's equity in order to keep the business alive.
Yeah, and you made great points that I want to bring up. This is a great example for 2020, right? So we have a lot of losses, and then we kind of make it back up with the PPP, EIDL, et cetera, right? Changes in working capital, and so on. However, something kind of outside of the 2020 and COVID, kind of the nuances that we've seen lately, we get the question a lot of, hey, I made a lot of money this year, or my P&L at least shows I made some good money, right? But at the end of the year, my cash hasn't changed. What the heck happened, right? And so regardless of whether it looks like this on the operating, kind of take this and what we're talking about as kind of the theme of using this as a tool to really understand the cash flows of the ins and outs of the business.
Yeah. One of the biggest things that this kind of illustrates, Korey, especially on the operating business side, is where in the business is that cash, right? Mm-hmm. And usually it's going to be in working capital, whether that's inventory, whether I've got a lot more cash held up in inventory, whether that's accounts receivable, I've gotten lazy on my collections, or I'm giving credit to my customers. Those are two big areas, kind of more on the manufacturing side, on the service side, inventory and AR. But yeah, that's a big place where cash gets eaten up, so that yes, you can say that you made $1 million on your P&L, but half of that you haven't collected, right? It's still out there it's cash that you've essentially invested in the business that you're not being able to collect from customers and therefore turn into cash on your balance sheet. It is on your balance sheet as receivables.
So Steve, how do you think that a operating business, we talked about this in the startup side, these venture-backed companies will probably use this to create a plan to show investors on what's going to happen, right? And let's translate that to the operating company where they're not going to have investors, but they may be building their 12-month budget, right? Their annual pro forma. How does something like this for an operating company go into forward-looking?
Yeah, it's a good question, right? How does this influence how you're actually going to build your execution plan, right? So if we do look at this as 2020, we had a big net operating loss. We had it, and the two main drivers here of consuming cash is net operating loss, and our AR went up by looks like 300,000, and so right there, I've consumed a lot of cash, right? Do I expect the same to happen over the next 12 months, right? Where is my business today? Where do I see it going over the course of 2021? Obviously, we all hope that we're going to kind of turn things around. We're seeing signs of that happening. Economies are opening up, even restaurants, schools. My kids are back in school full time this week, right? Like a whole different world, right? They're tired. They're like, the class is crowded, right? So it's a whole different world. We do anticipate and hope that things will get better on the business side, but what do we expect, right? If I have a big AR, we've talked to some of our customers about this, right? You've never had to pay attention to your receivables, right? You had good customers that paid pretty well. You had one or two that were a little bit delinquent, but you put kind of the relationship side of it above the like pestering them to pay their bill, and it all kind of worked out in the end, right? Everybody's happy, right? The conversations are getting more like, no, like you need to like have somebody dedicated to make sure that you are going after your receivables. It's to the point where it's, whether it's 45 days or 90 days, it's outside of your usual, and you really need to make sure that you're bringing that cash in. Otherwise, it gets out to 90 days, you're gonna have to write that down by at least a quarter, or if not in full. So, maybe you need to bring another person on board to make sure that your finance and accounting can be tight. Make sure that you can, spend owner's time, not chasing cash, but generating revenue.
Sure.
So I think it's helpful just to see where you've been, and then on the forward-looking side, what do we want this profile to look like next year, right?
Sure. Yeah, and I think to add to that, I think one thing that I want to reiterate is what I think a lot of people miss when building their pro formas by themselves is they'll build I'm selling X widgets for $10 each, and it costs me this much to produce them, and I have to pay my rent, I have to pay my phone bill, XYZ, right? At the end of the year, you look back, okay, my P&L looks the same, right? I pretty much executed to plan, but my cash dropped substantially, right? It's these debt payments, right? And so even if it's on a cash basis or an accrual basis, that's something that I feel like a lot of people don't understand the magnitude of that and how much that can grow.
Right.
And you may kind of re-lever up if your cash at the end of the year is not what you expected it to be, right? And it's gonna create a snowball effect. So that's one thing that I would kind of urge people to pay closer attention to in some of these things.
In some place we've seen that is, credit cards, companies run, people sometimes don't think of credit cards as debt. They look more like your loan payments, your car payments, things of that nature. But those are things that don't do, like to your point, Korey, don't show up on the P&L.
Yep.
So I can be making coin on my P&L, but if I'm putting cash just on the balance sheet from my cash reserves into my liabilities, none of that hits your P&L, and so therefore you can be making money on paper, but in the end your cash doesn't change.
If you're using the debt to fund the business,
you're paying the sins of the past, right?
Yep.
When you're paying down debt, or the strategic changes in your capital structure of the past. It's not always sins of the past.
Yeah. So with all this said, kind of between the operating and the startup, what would you recommend, Steve, for either business, right? Would you startup or operating? would you recommend they complete the annual operating plan, that 12-month forward-looking budget first, to build something like this, or would you recommend they kind of actually use historical data to create the waterfall first?
Yeah, I think it's a, I would go with historicals. Where have I been, right? So that your current state of what this visual looks like.
Sure.
Because it should influence your execution next year, right? Your budget planning process should not just be about pulling last year's budget, increasing it by 5% across the board, and there's my budget, right?
Yeah.
We should put more thought into that, and some that works for some companies, right? But when you really want to be able to communicate to stakeholders, whether that's your employees, your investors, here's where I was, here's where I am, and here's where I think we really can go, and here's why, right? You really need more explanation, you need more data, right? Than just like, here's what I did last year, I'm just going to do the same thing this year. It's okay to use the template, but you really need to look at what happened and how you need to adjust your use of resources, whether that's cash, whether that's people, whether that's property, plant, and equipment, right? You need to make sure that you're telling your stakeholders why you can achieve that plan.
Sure. At the end of the day, the data in, data out, right? The quality of the data that you use is what's going to influence building something like this. So don't take it for granted, I'll say. Cool.
Thanks, Korey.
Yeah, thanks, Steve.
And so next week we'll be continuing March Cash Madness and looking more at KPIs, key performance indicators for your business, both on the operating business side and the venture-backed business.
Cool.
So till then, have a great week, and thanks, Korey.
Thanks, Steve.